And that sound means we are live on YouTube, 8/28/2019, and the market's got some action here today. We're going to break it all down. We actually have a news segment as well, a fun one. We're going to play a game at the end of the day and get into that a little bit later. Matt, neutral market, cash flow central, in my opinion. Positive theta is the way to go until we get clarity. First off, how you doing today, brother?
Tim, I'm doing really, really good. We just got off an interview for the podcast coming out soon, and I'm fired up.
Very good. And Cody, young Cody, the producer, he has built a new little game for us, Matt. We're going to play it at the end of the show. What are we calling this one, Cody?
I think we're just going to call it Bulls versus Bears toss-up.
Bulls versus the Bears toss-up, where you're going to pick some companies. Matt will take one side. I'll take one side. We'll get to that a little bit later, but we're going to first start with the market. Matt, S&P 500 stuck in a range between support and resistance. Now, you've got complexity in the moving averages. They're all kind of coming together in what we describe as moving average soup here. And I don't know where the direction is going to go next, but I'm neutral. What's your read on the S&P?
It's the same read we've had for the last week and a half, 2 weeks, Tim. I mean, once you established, this as the bearish mark, as the market breaks support right here, you start this little bearish downtrend, you come in and you form a little bit of a bearish retracement, and then it starts to come back down in price. But once it establishes the exact same support level here, T, you got to kind of come off that bearish stance, because now you're in a neutral market. Pivot relationships are very important in neutrality, the same way they're important in a bullish uptrend or a bearish downtrend. And you're really just stuck in the mud between 2940 and really that 200-day moving average at 2800. But your really pivots are right here at about 2820. And so it's just neutral here. And like we talked about yesterday and the day before, I mean, we're just going to basically, trade the neutrality with the net neutral delta with positive theta until we start seeing a breakout one way or the other.
Yeah, correct. Give me a quick run through of the Dow, the NASDAQ, the Russell. Look at all the indexes. Stock markets are all fairly similar here today in my estimation. They've all moved in many ways into the same type of pattern. Give me a quick look at all of them if you can.
Well, they're all looking very, very similar here. So the snapshot on the S&P 500 is going to be very similar on the Dow Jones, very similar on the NASDAQ as well. So when you're looking at the Dow Jones, there is some subtle differences. The pattern's the same. You have your overhead resistance at 26,400, and you have your underhead, underneath support right here about 25,390 by 25,230. So you're really just stuck in that same type of neutrality that the S&P 500 is. The only difference is today you kind of kissed off that 200-day moving average. And, Tim, on an extremely slow news day, I mean, there's not a lot of news out there in the market. It's just kind of a technical bounce off that 200-day moving average on the Dow Jones when the futures market on the overnight was coming down. Cash open happens at 7:30 our time, 9:30 Eastern, and you see that price appreciation coming back up. So it's really just kind of stuck in neutrality here. Looking at the NASDAQ showing a little bit more strength than the S&P, than the Dow Jones, than the Russell 2000, but overall kind of weak here today in relation to the S&P, the Dow, and the Russell. But you are well above that 200-day moving average, unlike the Dow Jones, where you're kissing off that 200-day moving average. And then you have the Russell 2000 here, which is really just that technical bounce off that 1450 barrier that we talked about yesterday, and it's trying to recover, but the Russell's still weak in comparison. Even though it's having a really good day today, up 1.45%, it's still underperforming the rest of the broad market.
Yeah, I got it obviously ranked on the lowest out of all the indexes we just talked about. Move on to the dollar, and maybe the headline of the day. Old Boris out of the UK, he's talking about potentially shutting down the parliament so they can't vote on the no Brexit deal the day before they actually have it in October. He called on something about like the Queen's speech or something. I don't know British parliamentary procedure as well as I should potentially. Dollar's up. The pound is down excessively, Matt. Dollar index first. Give me a read.
Well, what Boris Johnson basically did is he asked the Queen to suspend Parliament from a 2-week time period where they wouldn't have enough time to really kind of stop the Brexit out that's happening in October. And it needs the Queen's authorization, and the Queen gave authorization. So that is going to happen. And that just increases the probability mightily that we're going to have a hard out with Brexit. And that's basically what Boris Johnson wants. And he did his job as a politician to do what the people wanted, and the people voted for Brexit. And that's what he believes in, whether or not Anybody else believes in it? That's not the point. The point is that he did his job, and his job is to do what the people wanted, and the people wanted Brexit, and it's going to create a lot of volatility and a lot of uncertainty in the short term for the British pound, and so basically on this slow news day, that kind of just sucks up all the energy. And when you're looking at the British pound here, GBP/US dollar, a lot of volatility here today, showing a lot of weakness coming back down, kissing off that trend line, showing intraday strength. But overall, I'm taking this as a sign of weakness for the British pound.
Don't you think it'll be a good thing for the pound when they can finally get past Brexit, no matter what the actual details of the deal are? They can strike new trade relationships, Matt, and they're not going to stop doing business with Europe over the course of 10 or 20 or 30 years, obviously. So I know the last few years, the pound has been under pressure, and a no-deal Brexit has lots of uncertainty and all that kind of stuff. But I would like it to get away from this news headline cycle at some point so the pound can get back to fundamentals.
Well, I think most people have stopped even caring about the pound. Not caring about the pound, but caring about Brexit. It's just been, we're talking June 16. Yeah. We're well over 3 years coming into this situation. It's been up and down and up and down. And, it really doesn't even have a market response any longer, Tim. I mean, if a hard out Brexit, if what happened today would have happened 2 years ago, the market would have went down aggressively, Tim, aggressively. Remember when the Brexit announcement was made? I believe it was in June of 16. I can't remember the exact day. It might have been like June 24th or something along those lines back in 2016. The market had a very negative response to that vote that came out of Brexit. And now today, when the probability shifts to extremely high that we're going to have a no-deal Brexit, the market goes up. That's just showing you the market just complacency around this issue, because we've seen it over and over and over again. And it's just that it does not have the impact that it once did. And so if we do get a hard out Brexit coming in October, which is most likely, I don't think it's going to have a massive market response, number one. And number two, Tim, before the 1992 agreement that created the euro, and you started forming the European Union coming into the mid 90s, coming out of 1999 when the euro was introduced publicly, the UK before that moment, I believe they did deals with Europe. I believe they did trade deals before they had the European Union. So I think they're gonna figure it out. They're the 5th largest economy in the world. They're gonna figure it out.
Here's a chart you don't see every day, Matt. /ZB, the 30-year U.S. Treasury bond. We were talking to a guy named Mike Malone out of Philadelphia about bond markets today, and it's got it on my mind. And also the headline today, the 30-year Treasury actually hit below 2%. I mean, we're talking about what you get your mortgages back by. A lot of banks are going to lend off of that rate, things like this. Rates are just continuing to drop across the board, but the longer term treasuries are getting the most bullish activity, which is bringing rates down. What's your read on the bond market?
Well, and this is one thing a lot of people don't understand, is that when rates go down, bond values go up, right? So when rates go down, the 20-year treasury is going to go up. /ZB, the futures 30-year bond, that's going to go up. And it's if your analysis, and we've talked about this in halftime reports of the past, we've talked about in podcasts of the past, but if your analysis is interest rates are going to continually go down over the course of the foreseeable future, a safe haven strategy is to buy bonds in that capacity. And for the consumer, they're like, well, why would I buy a bond when it's going down? Well, if you buy a bond on a 30-year note at 1.95%, I know this seems insane, but if the Fed fund rate goes from 2% over the course of the next year, 2 years, to 0% interest rates, this chart that you're seeing here will continue to rise. And so when you're looking at /ZB on the 30-year note, or whether you're looking at TLT, which is the ETF that tracks the 20-year note, this is a strategy that you can go to find some degree of safety. And when you're looking at this over the course of 19, and that's really when we started seeing the Fed, start to indicate that they're going to start lowering interest rates. Once you broke out of that, Tim, you went from 122 all the way up to 148. That's a tremendous amount of price appreciation. So even though the bond, over the course of that 6 months, Tim, the Fed fund rate went from 2.5% down to 2.25 to 2.5% to 2.25%. Well, just in a 25 basis point cut, this bond market has rallied by 20%. Mm-hmm. And so to new investors and new traders, they think, well, the interest rate only got cut 0.25%, but that has a massive movement in terms of the marketplace. And so if you're looking for some degree of safety, and you have utilities and you have XLRE and you have some consumer staples, and obviously you have some precious metals to protect against that, instead of going into cash, which is never a wise position, maybe you do pick up TLT. Maybe you do pick up, one of the plethora of ETFs that track the bond market.
Bonds are not a bad play, obviously. They're very, very bullish. They continue to hit all-time highs, and we're in an environment where nobody expects the Fed to raise interest rates at anytime soon, Matt.
No. And the TLT just broke out of resistance. So, yeah. I mean, the expectation for this has to be continually going higher, and it's a great way to get some safety in that portfolio.
Yeah, I agree with that. And welcome out Halftime Crew, by the way. If you're watching our show right now and you're new to our channel, click the subscribe button down on the bottom and click the little bell. And by the way, if you are watching and you haven't done it yet, little thumbs up button on YouTube always helps us get the word out, kick that information out there into the universe, no doubt about it. Love coming in here and talking markets with you guys. Oil next, Matt. Crude light actually up big here this morning. They had the inventories number, which I was watching the report and watching the event and actually stalled the rally. The rally was real good, and then the inventories number came out at 10:30 Eastern. And the market didn't like the actual number, and we're hesitating at the 200. What's your read here on crude light?
Well, it was interesting to kind of see it, Tim, because we had a drawdown of 10 million versus what we expected at 2.8%. And what is the typical response to the market when we see such a massive drawdown like that?
You think it would go up? Yeah, supply-demand dynamics for sure.
And yet, what did we see? On the cash open, we see this price appreciation on that breakout of 55.80. The announcement comes out right here, and you see that pullback coming back down into that channel. So a little bit of an unexpected move coming back down after what would be a positive economic report. So that was fairly interesting. You are running into the 200-day moving average here, though, Tim, and that's certainly going to play a role here. You're running into these trend lines that are driving down too. So it takes a lot to break out of resistance. It does. It takes a lot to shift a trend line, shift a trend that's going down. And so that report just didn't have the steam to break it out of all this levels of resistance. I still got a neutral rating on crude oil, and maybe even a slight tilt toward the bearish side, but neutral more than anything.
Neutral is the right call. If you put me on the 50-yard marker, I'd disagree with it. I'd put it on the -45 most likely because of the tilt. I'm with you as well. Move on to natural gas, if you would. I want to keep looking at this chart. And I'm anticipating something developing here through this fall to where we're actually going to be able to trade this again, Matt. It's been a long time. People forget this used to be a daily product we looked at every single day because of the cash flow potential, right?
Oh, we would cash flow on it every month. I mean, it really is a great cash flow strategy. I mean, when you're looking at UNG from a boomerang perspective, and let's look at UNG real quickly. When you're looking at UNG from a potential boomerang where you're doing naked puts into covered calls, it's a wonderful way to get some cash flow coming into you to invest in a commodity. And so when you're looking at kind of like that boomerang type setup, let me change that to the delta. I can go out to the market and I can sell a 17 delta, 18, strike, $18 strike, get some cash flow coming into me, $17 against 239. I mean, that's, 6, 7, 8%. And so you can get some cash flow coming into you. And if it ever gets put to you, you start doing covered calls on it by renting out that 40 delta contract and bringing in another $47, $48 of cash flow per contract coming into you on a monthly basis. And so it is a wonderful cash flow strategy. But when you're looking at it in the futures market here, you can see why a lot of traders love trading options on the futures. I can go out to a 10 delta contract, sell the 195 contract there. Let's drop that down just to one contract to show you the cash flow here. You can sell one contract, slide that into the mid, get paid $130 for $641 in margin to initiate the trade. And so a lot of traders love doing what's, naked puts or short strangles, bear call spreads, bull put spreads on this tradable instrument. But when this happened last November and December,
I was just going to say
it just shifted it. I mean,
I can't unsee the video of that guy from optionsellers.com. I just can't.
$200 million by selling naked calls. I mean, I think that just kind of spooked everybody that does, cash flow strategy from natural gas. because this went just vertical, just absolutely insane. And then it just drove back down in price. And so that volatility in natural gas in November, December, and January of last year, or January of this year, I think that just kind of really just spooked the market. But you're starting to see consistency here, Tim. You're starting to see consistency in trends and patterns and support resistance. And you're starting to see a little bit of a reversal formation here that's threatening a potential breakout for the first time in the foreseeable future. When you look at this trend line, if I draw this trend line again very quickly, when you look at the trend line of resistance, and you can connect those trend lines there, you have that trend line that it's starting to get threatened very, very aggressively. So I'm inching there. I'm inching there to get back into bull puts or bear calls, or I do some naked puts there as well, but I'm not there yet.
I'm not there yet either. I want to be there. I like the product, and I miss my old friend.
I miss it too.
My old buddy. I used to just do naked puts on all the time and all that kind of stuff. So we'll see. It's got to develop a little bit more. I'll tell you what doesn't have to develop a little bit more is silver. We're going to have to start leading with silver on a daily basis, up again another 0.6.2%. Just gone crazy up here, Matt. Is bullish. There's no question. It's clearly bullish. And it's a good reminder out there when you're position trading or investing, don't try to pick a top. Let something that's working continue to work,
Yeah, you don't pick a top on that strength.
No.
Maybe it's not a new entry, but it's not like, let me lock in profit. You let that puppy run. Just sit back and enjoy the ride on silver.
I agree.
It's going to be volatile. It will. It's going to be news driven. But if the analysis is we're going through a commodity boom, and that's what I believe we're going through in gold and silver, very similar to what 2009, 2010-ish, enjoy the ride, enjoy the cash flow, enjoy the money.
What's going on with platinum today? It's up 4.5%. Is that contract settlement? Did something happen I didn't see? I don't have any positions in platinum.
Oh, wow. I have not seen this.
This is going nuts here. 4.67%.
Halftime crew, find us some news. Find us some news on platinum, because I don't know.
That is a significant move. There's no question about it.
It's not just the move; it's the volume.
Yeah,
big time volume. Obviously breaking out, approaching resistance here. I'm not chasing it, but I'm gonna start looking at it daily.
Yeah, I'm trying to dig into the news. While I do, I'll see if I can find something. Give me a look at gold and palladium while we're looking at metals real quick.
Gold here just hovering above its resistance channel. Gold's not going to perform as strong as silver in this environment. Gold's a safety play. I love gold more than I like silver, but silver's the play here. Gold safety. It's going to lag. It's going to lag silver in this environment. But as long as gold stays now above that, now, I've been saying this for like months and months and months and months. As long as gold stays above that $1,300 breakout right there, you're good to go. As long as gold stays above that breakout at $1,350, you're good to go. As long as gold stays above that breakout at $1,430, you're good to go. As long as gold stays above that breakout at $1,460, you're good to go. As long as gold stays above $1,540, you are good to go. I've been saying it for months and months and months now. Breakouts have been very, very popular on gold, and it's going to continue to be.
We're in a low interest rate environment where we are having some muted responses in the stock market, but not in the metals market. Gold is very clear. Silver has been very clear. Bullish instruments, so many different ways to play it. By the way, Mike Malone was talking during our interview, Matt, about GDX and GDXJ. We don't have to do deep analysis of them, but if you don't trade the gold futures or gold directly, there's always the miners. The miners have been just as bullish here. GDX looking strong, Matt.
Miners have been more bullish.
Yeah.
The miners will be more bullish than gold, and the miners obviously kind of do very similar to what gold does. They're not 100% correlated, but they are very correlated in terms of their price performance. GDX is a wonderful cash flow instrument. It's a wonderful way to invest in the gold miners without taking the the earnings reports that an individual company has to report on a quarterly basis. You offset that because you're investing in all the mining companies. And, it just broke out at $30 just yesterday. That was a breakout channel. Today on GDX, look at the intraday, Tim. You broke out of that $30 right here. You broke out with some strength, high bases, snapback rally, snapback retracement coming back into the breakout channel at 30, response back bullish. You could retrigger back above the high, above the highs of today, or some degree of intraday resistance level here. But I like the miners here. Another way to get gold is to go GLD. and GLD is basically tracks the spot price of gold itself.
By the way, we've got 2 thumbs down here today, Matt. I don't know how I should feel about that. I kind of like it.
I feel okay with it.
Bring a couple of haters on. I got no problem with it. We're just bringing value and fun, and I'm enjoying it today. Guys, if you're watching me right now and you're enjoying it, let's beat those thumbs down and give us some thumbs up, actually. Positivity.
Team tackle. You hit that like button. Represent. When the haters come in, Team Tackle represents.
That's right.
I'll see what James put in the chat.
What'd James say?
Oh, that's funny. That's funny.
Yeah.
Listen, if you don't have a couple haters, you're not pushing the envelope enough.
Kramer, come on the podcast. We'd love to talk to you. If you're listening, if you're hating right now, I'd love to talk to you. No doubt about it. A couple stocks and news before we get into our game, Matt. Autodesk is one of them. It was down earlier today on earnings and gap down, backfilled here a little bit. By the way, not a crazy volatility gap. The MMM projection, I believe, was not too far off of what it actually did here. A little bit of a nice inverted butterfly play potential there if you were looking at them yesterday. Any reaction on an earnings gap like that, Matt?
I'm looking at the numbers. Give me a second very quickly. On the earnings gap like that, no, those snapback rallies here, Tim, after it gaps down, that makes it so difficult to play. I have not seen the numbers yet. Autodesk reports adjusted quarterly profit of 65 cents, 4 cents above the estimate. However, the stock is under pressure after Autodesk lowered its fiscal 2020 earnings. So basically, ladies and gentlemen, on Autodesk, it beat on earnings per share, but they lowered guidance. And so it's just a mixed reaction here. When you beat on earnings per share, but you lowered guidance, it's going to create volatility there. And for that reason, it would be a stay away from me. And that gap is really hard to read.
Tiffany's had earnings. They had a 2.3% drop at the open. We'll see where they are right now. Some disappointing numbers on their same store sales numbers, actually backfilling nicely. Still bearish in general, but that kind of just screams to me kind of neutral in the short term, Matt. It's not selling off aggressively.
Tiffany reported 1.12 per share, beating estimates by 8 cents. So pretty good beat on earnings per share. Revenue of comparable stores were below estimates. So they had some retail issues, same store sales, the issues, but a little bit of volatility. Kind of a mixed report, very similar to what Autodesk was.
Just a reminder, GDP up tomorrow. There's a pretty important news-based event coming out of the USD for tomorrow's currency traders. That'll be pre-market. We do have some earnings coming down the pipeline tonight. Okta, which is a company I like to trade. Box, which has been an interesting one. But tomorrow, I think, is the big one, Matt. Best Buy. Best Buy has earnings in the morning. We're talking about a major big box retailer. It's been volatile. I like the company. It's been on many of my lists over the years. There's no doubt about it, but just tradable option product. Break this one down for me, if you will.
What do you want me to break down?
MMM, what's the projected gap on this?
MMM on this is 5.6 versus 68. What's that percentage-wise?
It's about 8.
About 8% earnings gap expectation. Earnings gap here, no gap. Earnings gap here, big gap, went from 60 all the way to 68, $8 movement on that one. Good little 12% movement. Not really a gap here and not really a gap over there. Based on this one earnings gap here, it's thrown off the projection.
Correct.
Just given the fact that, out of the last few gaps, it did run after the market. It ran after the market and it kind of dojied here after the market. But you got 3 out of 4 earnings gaps that are underperforming the market maker move, with the one that kind of just blew up the market maker move. So I would say you have an edge to see less volatility than what the market expects here.
I think so as well. I mean, that could be the thing where you're selling the vol. Yeah, I agree with that.
Yeah, Devicon or short strangle, I would say.
Something like that. Yeah. All right, guys, that's our market skyline. Now we're going to get into a new segment. And guys, whenever you try something new, obviously it's exciting. We don't know how it's going to go. But Matt, we think we even have some old production for this. You want to play that? I do want to hear it. I want to hear that.
You want to hear it? You want to hear it? Okay, yeah. Let me see if I can find it. Now, before I play this, guys, this video, and for old school, I'm talking OG tackle traders, right? I'm talking 14, 15, and 16 tackle traders. This you'll remember this because this was kind of the the intro music to some of our videos we would put out there on our YouTube channel, or, you know, to our pro members, or whatever the case is. So a little bit of nostalgia here. Let's go ahead and play the intro.
The Bulls versus the Bears. Get in the game. www.tackletrading.com.
That just makes me laugh.
Oh, I love it.
Happy.
All right, so guys, here's the rules of the game.
Very quickly. You know, a lot of people don't understand the backstory. We had that. The funniest drop she ever made for us was she was trying to pronounce the Chinese yuan, and I was having her I was like, I didn't do this, but she was trying to say the Chinese yuan sucks. Okay. And she's recording the video, but she doesn't know how to say the Chinese yuan. She keeps on suck you on. And I'm just like, oh my God, it's so funny.
There's so many funny audio drops in our Dropbox. I'm gonna have to go. I could spend 2 hours going and listening to them. It makes me happy.
Blooper reel, guys. We don't have a blooper reel yet. We have so much video, so much audio.
We could definitely.
I got a few bloopers from Mark on live reads.
All right, Cody, set up the game.
So here's the idea of the game, guys. I went through and I picked out 4, possibly 5 if we need a tiebreaker, neutral charts. And what I'm going to do is I'm going to name one of them. Matt and Tim are going to call whether they want to go bullish or bearish. Whoever calls it first, the other person has to take the opposite side.
Okay.
And then what they're going to do is they're going to make a bullish or bearish case on that stock. Now, these are neutral charts. They may have a slight lean one way or the other, so someone might have an advantage in their case. Whoever makes the best case, I'll award some points.
What's our time frame?
Well, we got 15 minutes to go through 4 stocks.
No. What's our holding time frame? Is this a swing trade, position, investment? Because any trader's going to find an edge on time frame.
Touche. I like the clarity. Let's say
position. Let's go position.
Yeah, let's go position. 1 year, 1 year or longer. You're holding this thing for 1 year.
1 year. Okay, 1 year is our time frame.
But yeah, that's the time frame. 1 year.
All right.
All right. So we're going to start off, and we're going to start off.
And by the way, we don't know what these stocks are.
Yeah.
Okay.
They don't know what it is. I've looked these up.
We asked Cody to tell us the stocks so we could do a little prep work.
No.
And Cody's like, no, rapid fire this. Come on. All right. First stock.
All right. We're going to start off with Alibaba.
I'll let you go first, Steve.
All right, I'll take the bull. I'm going to go with the bullish side. All right, Alibaba is one of the most well-respected brands internationally, not just in China. And obviously, we're talking about the U.S.-China trade war that has held this stock back. The FXI has been under pressure for 18 months now. I mean, it's not been a good performer. I believe over the next year or longer, we will get clarity out of the trade war. And that clarity out of the trade war will get interest back into the Chinese stock market, and who's bigger and who's better, and also great leadership out of Alibaba from their CEO, I believe Jack Ma, if I'm right. $450 billion market cap. I think we're seeing $1 trillion company in the next 10 years. And at a PE ratio of 30, you've had to pay 50, 60, 70 PE ratio for Baba in the past. I'm bullish on Baba long term.
Okay. Considering the trade war, as long as that trade war exists, Baba's not going to outperform the market. It's just not going to happen. Okay. When you're looking at that trade war, the most likely scenario in the trade war is the historical example would be the 1980s of Japan, when the US and Japan had a decade-long trade war, which led to Japan going through basically printing money to offset the trade war, very similar to what China is doing now, lowering the value of the Japanese yen. And if you remember back in the 1980s, Japan was supposed to be that up-and-comer currency, the up-and-comer economy. And the U.S. and the Japan went through this trade war, and it had a prolonged impact on the Japanese market, to the point where the Japanese market never recovered those all-time highs from 1988 throughout literally 2019. It's had 30 years of economic stagnation because of what Japan did in response to that trade war. When you're looking at the Chinese versus the U.S., they have timeframes. China is playing the long game. There was a report here today that China is simply, they don't trust Trump, and they don't trust that a trade agreement's going to be done. And all they have to do is outlast Trump. That's all they have to do, according to the Chinese government. And so from a time frame perspective, I do not see China playing ball with the U.S., given the increased rhetoric with the U.S. And China's going to play that long game here. And so in my opinion, BABA is not a good buy right now, especially in comparison to many other stocks that are going to completely outperform it. I do agree with Tim's premise that that BABA 10 years from now is a $1 trillion company. It's led by one of the most fantastic capitalists out there, but they can't overcome that Chinese trade war, and China's going to play the long game here. BABA's a sell for me.
So now Cody gets to decide who wins. Is that right?
Yeah. So I'm gonna that was a pretty compelling argument on both ends. Matt, you started to deviate for a little bit, but you did bring it round circle for a second. I was like, what is he going at here? So your argument is basically that with the trade war and the tensions, that it's not going to recover anytime soon, and it's going to look bearish for the next year.
I'm saying if you understand history has a tendency to repeat itself, and China
feels like a counterpoint.
Hold on, China's playing the exact same game that Japan.
And Tim, you're saying it's a good fundamental company, so overall we'll be fine.
Well, sales per share literally over 5 years in a row has gone up over 20-30% growth year over year. Their sales, their revenue, their earnings, and at this valuation, this is the most attractive valuation you've had for BABA in a long time.
And yet in that time frame that Tim was just talking about, BABA has decreased in price. That is a winning argument right there.
Cody, call it.
Matt's got the point on this one.
All right. Sounds good. Right. Matt won. Let's roll. Bad
call.
We're
going to go with Goldman Sachs, GS.
Ooh, Matt, you get to go first on this one. What do you want to pick?
I'll go on the bear side.
Of course.
I should have made Matt take the bear.
Oh, really?
Tim, you should have said I'm taking the bear. Force Matt to make a buy for Goldman Sachs. I would have quit and hung up. I would have walked out. I would have stormed out of here. No, I'll take the bear side of it. PE ratios across the board are at not all-time highs, but the second highest across the board. The financial sector has been completely underperforming the marketplace over the course of the last, really the course of the last 3 years. I expect the financial sector to continue to underperform the market, including in bear markets. Think back to 2008, 2007 through 2009. The number one sector that got beat up in that bear market was the financial sector. And the financial sector is what caused that market crisis. And we've done the exact same things over the last 10 years that led into the subprime market crash that is now in the all-everything debt bubble, except times it by 10. And so when you're talking about, buying Goldman Sachs for the next year, when the most likely scenarios, we're going to go through a recession. And in the last recession, Goldman Sachs got absolutely smoked. I mean, when you're looking at this time frame on the chart here, and let's go back to 15 years to look at that 08 crisis. Here's the 08 crisis, 240 all the way down to 60. That's game over. If you touch Goldman Sachs going into a recession, you expect to lose money.
Okay, this one's an easy argument, and I will handily win. It's an 8 PE ratio that pays a 2.5% dividend yield at support in a long-term uptrend on a company that buys back their shares consistently, creating artificial demand for the stock. It is one of the most notable names in the financial sector. Sales year over year, 2016, 38 billion, 2017, 43 billion, 2018, 53 billion, increasing sales year over year. Shares outstanding continue to come down. We're talking about an 8 PE ratio in one of the most notable and recognizable names in the marketplace.
Once again,
and by the way, on the daily chart, you've got a nice trend line.
Again, on everything you just said, Goldman Sachs been dropping in price. It's down 25% based on everything you just said. And companies across the board are stopping buybacks because of what's happening economically.
No, it's not down, actually. Performance year to date, it started the year at $165. It's at $200 a share. It recently hit a high at $220, came down with the trade war concern and all the risk. It is market performer, but a good valuation.
Let me ask you a question. Let me ask you one specific question.
Mm-hmm.
Are you going to buy Goldman Sachs today then?
It's not a today or not today question.
Are you gonna buy Goldman Sachs?
It is a buy. It is a bull. It is a bull.
Are you going to buy Goldman Sachs based on your argument?
The game isn't step trading, Matt. The game is not step system swing trading, whether or not we have a trigger
I'm talking,
or not.
are you going to own Goldman Sachs over the next year going through a recession?
It is a bull. It is a bull. It is a bull. I'm feeling like point counterpoint.
All right. I gotta say, guys, I'm loving this. This is working out perfectly, just like I wanted. Tim's got the point on this one.
That's right. That's right.
An 8 P ratio is not a good thing with an average P ratio of 30. That means
next.
All right, moving on to the next one. We're gonna go with Facebook.
Ooh, Facebook. Sell this dog.
All right, Tim, what's the bear side?
taking the bear side of it. All right, listen. Simple. You're in a market condition that has risk, that has complexity, and that you have to put your money somewhere. I would much rather take a low PE ratio company or even a conservative company in a risk-off type environment. McDonald's, Starbucks, Procter & Gamble. And I think when the market's approaching the fall time here and we've got all this uncertainty, companies like the FANG companies with high PE ratios, there's going to be a concern. Now, Facebook has some strong fundamental numbers in terms of sales and growth, but it's put the PE ratio still up at 30, which is still in an overvalued position.
You just made an argument on Baba that 30 was a buy.
Different companies. Okay. And the other thing is, I think the public is turning on Facebook. They have been for about a year now. And really, I think you're seeing a lot more demand naturally just being used on sites like Pinterest, sites like Instagram, which they do own, but Facebook might get broken up by the SEC and the Department of Justice. You might not have the strength of those products because you might have to have separate companies as we move forward. A different Facebook company than an Instagram company. You add the legal risk into it. I'm a sell, I'm a bear.
That's a lot of hypotheticals over the next year of the U.S. government breaking up Facebook, which I just don't believe is going to happen. That's number one. Number two, I believe we're going to be going through a recession. I believe the economic factors support that argument. I believe the inverted yield curve supports that argument. And in a recession, not everything goes down. Not everything does. Okay. Recessions are a scarier word than they are in economic reality. Stocks go up in recession. Walmart went up 22% in 2008. Not everything goes down. Here's my argument. In a recession, people have a tendency to do certain things. Okay. Number one, they drink more. Number two, they smoke more. Number three, they gamble more. Number four, they gain more. And Facebook has never seen a recession. We've never seen social media companies, how they handle a recession. But how does Facebook make money? Facebook makes money based on one simple reality. When they IPO'd in 2012, I was very concerned with Facebook because of how they made money. They made money based on a pay-per-click model, which means they only made money if you went to their website and clicked on the ad. In 2013, we found out that Facebook, 50% of Facebook clients, they never go to the website, they go to the mobile app. And how does Facebook make money on the mobile app? Well, we didn't know. They changed their marketing message in 2013 to be a scrolling, sponsored by, promoted by. And so Facebook makes money not based on you clicking on anything. Facebook makes money simply on you scrolling through your feed. And when we're in a recession and people get fired and people are drinking more and people are smoking more and people are getting high more, well, guess what? They're going to need an area to go bitch and moan about it. And I guarantee they're going to be on Facebook a hell of a lot more.
Why not Twitter? That's the point. Why not?
I didn't say Twitter. Did Cody say analyze Twitter? Because
I'm saying there's natural competition against Facebook. And even if everything you just said is true, they still have to pick some platform. It could be Quora, Matt. They might go to Quora and answer questions.
Twitter doesn't even have a candle into the wind to what Facebook.
All right, Cody, call it.
Facebook is the number one marketing company in the world. They're the number one marketing company online. Twitter, Pinterest, and every argument you just made, they are nothing compared to what Facebook does. Facebook is a giant. That's my argument.
Matt's got this one. Tim, you also gave him, and you did the debate thing where you said, I recognize they have this good, but then you never broke it down afterwards. So you point out something.
Here's the thing about that one. Like an argument on Facebook, I gave up a long time ago on that one. I know Matt wins.
He knew when he said buy, he knew what I was going to say. That's why I was. That's why I was a little surprised you wanted to take the. I thought you were
all
gonna.
right, we got Matt with 2 right now. Tim with 1.
Matt
Tim
gets the point. He wins.
Tiebreaker.
So we're going to 3, right?
We have 4. I have a 5th if needed.
Okay. So all right, sounds good.
Next and possibly final if Matt can pull it off. If not, Tim, you got to tie it. Boeing.
Ooh. That is such a tough one, Maddie. You got to go first.
That's a tough one for me.
I tried to pick some tough ones. I tried to pick ones that had some political risk. I tried to pick ones that in the charts were neutral. I did this purposely.
All right, I'm going to take the buy side of it.
All right.
I'm going to take the buy side of it. And the reason I'm going to take the buy side of it is very simple. Boeing is one of those companies in the world that has such great brand recognition that has made some missteps in the previous year. Number one, they're going to figure it out. That's number 2. They're going to figure it out. Boeing's not going away. We saw not factory orders, but we saw it at the Paris Air Show. We saw it sales come in for the Supermax plane. Sales come in. They're starting to pick up their sales. Boeing, when they got sued just the other day, Boeing just didn't even respond to that lawsuit. But in terms of my argument for Boeing, it's really this. If Boeing's ever threatened and we start going through a recession, I promise you one thing will occur. The United States government will never allow Boeing to fail. They will never allow Boeing to fail. And that gives you a safety net to where you can cash flow on this company without the fear of it ever going away, get paid the dividend on it. It's a safety play right now. That's my argument.
Okay. This one's simple.
It was so simple, it cut him out.
On capital that you can invest in.
Oh, there it is.
So,
Matt, Tim, you got to start over. You cut out.
All right. I'm going to make this very simple. Okay. And I'm going to break this down point by point by point. And it's going to be pretty quick. Number 1, if you're going to put money into aerospace and defense, great. I like the sector. I like the industry. There's been a lot of great companies. You're going to tell me you're going to pick Boeing over Lockheed Martin, over Northrop.
Was that the question?
No, but it is part of the question.
Why
if you're going to buy something,
up other stocks,
you are going to buy something.
Cody, let me explain.
You are not buying something else. There is limited amount of capital that any account has to work with. So a buy on Boeing is choosing it over some other part of its competition. I love the brand Boeing.
Cody, you can't win an argument by saying you should buy another company.
With the legal risk, with the political risk, with the fact that the chart is
not legal risk. That was a $25 million deal.
Absolutely.
Boeing's a $300 billion company.
There's more of those deliveries, and we still don't.
Give me a company.
Do not know when they're going to roll out the 737 MAX. If I'm going long aerospace and defense, it's Lockheed Martin, Northrop Grumman. I am not picking a Boeing at this time just because I'm wanting simple trades. Pick the low hanging fruit.
Okay, Cody, if you allow me to say, okay, it's not Boeing, but let me go look at something else. That's not even an argument. Number one. Number 2, whether you agree with President Trump or not, President Trump supports the military, and he supports increasing government spending on military, and that goes to the Lockheed Martins, and that goes to the Boeing. And when you're talking infrastructure, if we get an infrastructure deal, you're talking digital and physical infrastructure. Boeing takes part of that as well. You're talking massive government stimuluses that are going to come into 2020, very similar to what happened in 2008. But if you want me to go look at the other 30 companies and compare all other 30 companies, maybe I can go find you one with less legal risk.
You're paying a 40 PE ratio. You're paying a 40 PE ratio on a company in a neutral chart.
That is the biggest lie in the history of mankind, and you know it. They had a one-time short from the lack of sales in one quarter that caused that PE ratio to go up. That is, and you know that for a fact.
That's the PE ratio on the chart right now. And not only that, you have a neutral chart, period. I mean,
okay, Tim, when bear markets happen and PE ratios get exploded, does that mean it's a good buy?
Cody, I'm not the judge here. You're the judge, kid.
Oh, no,
At some point, you have to come in and stop counterpoint and make a decision.
Okay. But it's our audience is enjoying this right now. That's why I didn't stop it. But actually, I will award this point to Matt. He did take the game because, Tim, you had to make a bearish point. You did not make a bearish point.
Make a bearish point.
You made I'm not buying this one. I'm buying something else. You made a non-bearish. bullish another company.
Garbage game. All right.
We're going to keep this one because everyone seems to love this. I'm going to put this game in the pocket.
Oh my God. Look what Mark started. Mark started this. Mark's the older brother that likes pitting the two younger brothers against one another. And then he just sits back with his popcorn like an evil genius that's watching the fireworks happening. And now it's across the board at tackle. Oh, man, this is.
I had fun. It was fun. All right, guys, that is our show. Lots of stocks on the option report that are triggering here today. Stock report as well. Go and double check your watch list. Make sure you're managing your accounts appropriately and all those kind of things. Content at Tackle Trading. Stock of the week we just put on our Instagram channel. Go check that Instagram feed, Tackle Trading. Like and subscribe on that channel as well. One of the social media channels we're trying to get out there. I think other than that, Matt, what do we got tonight? I think we have the Bear Market Survival Guide Mastermind Group. Is that right?
I'm not sure. I haven't looked at it.
I think so. I think we usually do our mastermind groups on Wednesday. Coaches Show replay from last night. Cash Flow Club tomorrow. If you're not a pro member, sign up for a pro membership. It is the simple thing that we do here. We promote our pro membership. We love it. We pack it with tons of value, shows and webinars and reports and all kinds of content. If you are a pro member, just type in pro member in the chat and let us know what we can ever do for you. Matt, I miss anything here?
No, it's fantastic.
We're done, guys. All right. We'll see you tomorrow.
We're out, everybody.